Welcome to this Hangout in the context of the Future Learned course, Decision Making in a Complex and Uncertain World. Today's topic is financial stability and financial crisis. We have one of our students live in this conversation, Andrew Carr, and we will also discuss some questions from the different fora that we have. So, summarizing, tonight's agenda is as follows. I will first ask our student Andrew Carr to briefly introduce himself. Then the representatives of the course team will briefly introduce themselves, and then we will move on to asking Andrew to ask and to raise some questions and issues, which we will then discuss for, let's say, 20 minutes or so. And then finally, at the end of this conversation, we will discuss the questions from the fora as announced. So let's start right away. Andrew, may I turn to you and ask you to introduce yourself? And if you have some observations about the course, please feel free to make them.
Yes. My name is Andrew Carr. I did my education at Harvard and MIT and have been a consultant to financial institutions and actually the founder of one. I came to this course because even at first impression, it seemed perspicuous. It had a broad outlook on the crucial issues that we're facing, as opposed to promoting a certain doctrine or a particular theory. That appealed to me, and I found, going through the course, that that expectation was sound and vindicated. So I'm grateful to you, Lex, and to the course staff for giving us an experience that isn't straitjacketed by some idea of here's how consumers are supposed to act, here's what rational decision making is, all kinds of normative stuff, and yet that aims at identifying threats, identifying vulnerabilities, and suggesting possible solutions to them.
Great to hear, and thank you, Andrew, because that was indeed our intention, not to be biased in any way, and really have a very open way of presenting the things. So before we get to your questions, let's first turn to Dirk Bezemer, the teacher of this week, to introduce himself. Dirk?
Thank you, Alex. My name is Dirk Bezemer, Dirk in English. I'm currently an associate professor at the University of Groningen. My research and teaching is in the field of banking and macroeconomy, global finance. Before that, I worked in development economics as a civil service servant and as a consultant. And I'm very excited about this course. It really takes a new view on a broad array of topics, so I feel very much at home at this course.
Okay, thank you, Dirk. We now turn to Tim, whom we already know from the previous Hangout. So, Tim, please reintroduce yourself.
Hello, my name is Tim. I'm a student at the University of Groningen. I study philosophy and international business, and I've been part of the team creating this book since February, and really enjoyed working together with all the professors and learning about complexity and uncertainty. It's really broadened my learning experience. So it's been a lot of fun, and also it has been a lot of fun to see all the students you go through the course, and the level of the discussions has been really high, above my expectations. My compliments to you.
Thank you, Tim. And I'm Lex Hoogdan. I'm the initiator of this course, which we really have made and produced with a team, and so far it has been really a great experience to develop the course and also seeing how it developed over time. And tonight we have our second Hangout. The previous one I enjoyed very much, and I hope we will do so tonight or this time again. So let's turn to you, Andrew, and let's start. Let's get rolling. Let's start a discussion of this Hangout. What would be your first question? Or questions?
I'd like to ask, according to U.S. government officials, even in recent testimony, the bailout of the big insurance company AIG was crucial to preventing what would have been a total systemic collapse if that company had been allowed to fail. And I just want to focus on what I saw as two of the factors in the near bankruptcy of AIG and hear from the experts whether those are of general concern, what can be done about them. Those two factors are, one, the tremendous expansion we've seen of financial derivatives outstanding, financial derivative trading, and if you went back to the middle of the last century, all of that would have been unthinkable, or even 30 years ago. So AIG in particular had 400 billion of derivative positions, and that was enough to kill it. That was one factor. The second factor, also not unique to AIG in this situation, was that there were agreements and there were rules, the general nature of which was that if a market participant, if AIG began to get into trouble, became less solvent, less creditworthy, then it was subject to more stringent requirements, had to put up more collateral. A slippery slope that you get a little bit weaker and they shove you down. So my question is, are those two issues ones that we need to address in aiming to stabilize the system and look beyond questions of the vital questions that were emphasized in the course of valuation bubbles, asset bubbles, and so on, but some other causes of systemic vulnerability?
Thank you, Andrew. Great questions, I think. Dirk, let me first turn to you.
Yeah, so those are clearly questions by a specialist. You go right to the heart of the matter. I think I would like to take a broader look at that. So you mentioned derivative positions, and if I understood you correctly, the importance of collateral and the danger that collateral values decline. I'm not quite sure that I got the second point right. Is that
the second was to be concrete in the case of AIG. As long as they had a AAA rating, they didn't have to put up any collateral. If they dropped one notch in their rating, they had to put up some. Drop another notch, and they have to put up more. So there's an increasing momentum, going downhill.
Yeah. So absolutely. I mean, so I'm not familiar with the details of that case, but let me immediately pick out two broader concerns which map onto your specific examples, right? Starting with the first one, outstanding derivative positions. I think this example should teach us a lesson, and the lesson is not that derivatives are wrong. Actually, derivatives have existed for a long time. They already were around in the second half of the 19th century in one form or another. But it teaches us, I think, that we should look at gross positions, not net positions. So you should look at the gross exposure that, in this case, firms have or countries have, and not at the net exposure. So there can be very large gross derivative positions which may be balanced or hedged by other instruments, but the question is, how well will that hedge or that balance work once you are in a crisis? And when you are in a crisis, the gross exposure is typically what really counts, and not a net. So I think that is something that you see in all financial systems. And when you want to understand their complexity, it is the amount of exposure that parties have to each other, and there often the gross position counts. So that's a very different view from looking at net positions. As an aside, looking at net positions ultimately would mean that you have zero positions, because every asset is balanced by a liability, which ironically is just a reason that in macroeconomic models you don't see a financial sector. So that's a very dangerous thing to do. That's the first thing. The second thing about collateral values is a very good example of discontinuity. A discontinuity, or as complexity scientists call it, a state transition. So you go from one state, which seems to be very stable, whop, in the blinking of an eye you go to another state. and rules like having to put up collateral beyond a certain point, which then cascades into much higher collateral requirements, are very good examples of the potential for sudden state transitions. And that is what characterizes complex systems, also in biology and so on. You can suddenly go from one state to another. And the strange thing is here, and then I'll shut up, I promise. Strange thing is that before the transition from one state to another, the system is often very stable. So that can be very misleading. A very stable system which suddenly changes its state from one which seems to be completely safe, low risk, etc., to one which is completely in tatters.
May I add something to what Dirk already said? Andrew, the point that you raised, I think, is a very important one, and it was one of the concerns of even the G20 after the financial crisis, how to deal with derivative positions. And it was decided one of the measures taken after the crisis was to make obligatory central clearing and also trading on central platforms of derivatives in order to enhance transparency and also to make the netting possible that Dirk referred to. And so that was one measure that has been taken. So that means that we now change the financial network and put central counterparties in the middle of derivative transactions. How that will work out in the end, it's too early. It's too early to tell. What is interesting though, that for instance in the bankruptcy of Lehman, there were a lot of open derivative transactions, and they were closed out very successfully at that point. But that's just one example. It shouldn't give us too much comfort. We have to see how that develops going forward. Your second point is really a very general point, and I think a problem for which there is no, let's say, golden bullet or golden key to solve it. It's basically the point of what we technically call pro-cyclicality, so that what you call the slippery slope is the situation begins to deteriorate, you ask additional collateral, which brings further problems, and so you get into a vicious circle. And that's pro-cyclicality. What measures try to do at the moment is to reduce and to mitigate this pro-cyclicality. For instance, by not having that process that you mentioned, but having, for instance, collateral and margins based on an average of the past 10 years, or having collateral determined by what is required in normal conditions, and then add 25% to that, so that you don't have to raise collateral requirements immediately if the situation starts to deteriorate. Now, all these are recent measures. How that works out in practice, we still have to see. And in any case, to completely get rid of pro-cyclicality is probably a step too far. Andrew, I think there is, if you feel free to respond to how we responded, but also there is, I think, certainly still time for another question that you may want to raise.
Another question has to do with automated trading and hyper-frequent trading, that as recently as last Wednesday there was a change in value of a benchmark treasury bond in the U.S. that was considered a very dramatic change and unexplainable by most of the market participants. And we've also seen situations in which the electronic machinery froze up, trades had to be reversed, whatever. There was a very dramatic event in 1987. So my question is whether, as you view the we could call it a failure diagram. You know, if something is going to go terribly wrong, what would be the possible major causes of it? Those are the things we should worry about. Is this placing of trading power in the memories of the machines and making trades often with they locate their trading computer right where the exchange is and so forth. Does all of that markedly increase the systemic risk, or would you say maybe it reduces it, or maybe it's only a minor factor?
Dirk?
Yeah. What you see happening with is rational and, as we like to say, optimal for the person doing it. But it's not optimal for the system, and that's an important difference. And the view that we take here is always a systemic view. So we try to understand what's going on in the light of what it is doing to the system. Now, for an individual trader, it's always better to be faster. It's always worse to be slower. And I think we need to take into account in our regulation, but we as academic economists in our models, that what is good for the individual may not be good for the system. So in this example, responding faster may lead to faster meltdown of the system, or it may lead to introduction of noise into the system, right? So the idea that if traders respond faster, this will lead to a better functioning of markets, in empirically shown wrong by automated trading. And this is something that actually that economists have been fighting over for 70 or 80 years. This goes back to debates of the 1930s. Is it better to have decentralized information or centralized information? But also when you have decentralized information, but then you centralize actions again in trading machines, you can have malfunctioning markets. So I think that of course regulation is always behind the facts, but regulation should take into account that the actions of individuals or the actions of individual trading machines may actually mess up the system, and they should take, well, there should be rules or incentives. I don't quite know how to do that, to be honest, to stop that in the interest of the system, not in the interest of individual traders.
Yeah, if I may add to these general reflections, I find this a nice example of, let's say, unintended consequences of interacting computers sometimes and or individuals, that things may happen that you cannot foresee and could not foresee. And we have you mentioned a couple of examples, and we have had others. And so far, I think the consequences have not been very serious, but nobody can guarantee that will remain the case. So it is a very important topic to study further, and to think about how to improve, let's say, the stability of markets, even if they operate very, very quickly. As you may recall, after 1987, some measures were introduced, like circuit breakers and so on, to avoid that these processes accumulated. But apparently, those circuit breakers cannot, as yet, completely prevent, let's say, the type of events that we saw last week, when we had a very rapid move, as you said, in U.S. government bond markets. The move itself, if you look at it on a daily basis, was not that large, but it went very quickly. And then it had knock-on effects in very many places, which are very difficult to foresee. So apart from trying to understand what may happen in such an interaction process, I think Another measure that you think about and reflect about is on how to make the system then resilient. Or if something like this happens, the circuit breakers and other type of measures. That was what I wanted to add. I think looking at my watch, it's perhaps time to turn to questions from the fora. And Andrew, just stay of course on the line. If you think you have to add something, please feel free also to join the discussion from now on. But already now, thank you for your questions and your participation so far. Tim.
Thank you very much. I've enjoyed it.
All right. I would like first to turn to a question from the audience. Let me see if I can show this to you. This is, I'll read it out loud. It's a question from Bram Witmer, and he's asking, can you say that the cause of the 2008 financial crisis was the indigenous vulnerability of the United States financial and banking system? Should I repeat it?
No, the question is, I think, clear. So, Dirk?
I wouldn't agree to that. I think that's too limited. I think that if it was only the banking system who'd been vulnerable, then there might have been a banking crisis, as there was, but there was a macroeconomic crisis and a recession that lasted for years. And it takes more than just a vulnerable banking system to achieve that. So I think that at least two other causes should be brought into play. The first is the high levels of private debt in the United States, and as it turned out also in many other countries, and that increased vulnerability of the macroeconomy to a failure of the banking system, because that meant that households and firms were very much dependent on banks in the first place, and second, were very vulnerable in the sense that they would quickly and substantially start reducing consumption and investment once collateral values, house prices, started going down. So that whole sequence of events, I don't need to repeat it, that could only play out because levels of debt were so high in the economy, so in what we call the real sector, as if the financial sector is not real. And I think the second factor which you need to bring to play, not just talk about the US financial system, because in my own country, in the Netherlands, several banks had invested quite heavily in junk mortgages and in other financial products, derivative products mostly. And it's this global interconnectedness with the US financial system which made the crisis what it was. It was truly they say a global crisis. It was a Western crisis for sure. Had that not been the case, it would have been a US crisis with spillovers in trade, but not spillovers through financial channels, which we've seen. So I would certainly add those two factors to understand what happened in 2008.
I find this a very relevant question in the context of our course. We have tried to emphasize throughout this course that the financial system and the economy at large are complex systems. And it is very difficult in a complex system to just determine one cause for certain developments. It's the interactions and the interconnections that Dirk referred to that play together and then lead to a typical crisis. Very difficult to just point out one factor. It's always a web of causes, and we can distinguish certain patterns, general patterns of interacting factors, but there are also rather specific things playing a role. So you really have to dig into in the history to understand a specific crisis, and it's hardly ever the case that you can just mention one cause.
All right. Shall I go to another question of the forums?
Yes.
All right. This question is from Tineke Verheijen. She asks, how can economists successfully influence policymakers and political decision makers, and thereby reduce the risk of crisis. It's not really attractive to take preventive measures when the economy seems to be booming. At the next elections, the politicians responsible for taking these measures will probably be punished by the voters. So, how can economists successfully influence policymakers and political decision makers to reduce the risk of a crisis?
Yeah, well, that's a big question. And the first thing we should say is that economists are not outsiders. Rather, so much like in physics, by observing what's going on, we change what's going on because we are part of the system. Economists' opinion, pundits writing in the financial press, economists who turn ministers of finance, and so on. So we are part of the system. It's not as if we influence. But so having said that, I could say a number of other things which you can probably come up with yourself, Tineke. Having said that, I think the most useful role that economists can play is to offer a variety of perspectives. And that's often frustrating for students or for politicians alike, but economists should really stick to that. I think one of the big things that went wrong in the economics profession before 2008 is that it became too monolithic. It became too much one opinion, one school of thought, to the exclusion of other perspectives. And that fits very much with the complex system perspective, because complex systems are not cannot be understood from a certain ideology or one methodology, in mathematics or whatever. You need different disciplines to understand complex systems. And you need different disciplines but even different views within economics to give useful advice. Now that may all sound very woolly. Concretely, before 2008, there was very little attention to interaction between individuals, and only a lot of attention to individual decision making. Interactions, turned out to be so important that here we are doing a course on complex systems. The second thing is that before 2008, there was very little attention to uncertainty.
Are we losing Dirk?
I think we have a problem here.
Okay, let me then add my reflections on this question, and we see whether Dirk returns. I think it's a very, Tineke pointed a very important point, that indeed, while the times are good and let's say the economy is growing rapidly, many people have an interest in that to continue. So there are no strong forces to correct the formation of a bubble. And again, I don't think that there is a simple solution to avoid that. But there are a couple of things that you can do. One thing is that you make the system more automatic, that you do not give policymakers a lot of discretion in making decisions. That there are automatic rules that have to be followed. That's one measure. Another one is that you make an independent institution like a central bank or a financial stability authority responsible for stabilizing the economy, and that such a institution like the central bank can operate relatively independently from politicians and others who have an interest in the bubble continue to build up. And then finally, I think it's we have to face the fact that altogether prevent bubbles will never be possible. So on top of, and in addition to trying to prevent the buildup of bubbles or make them smaller than would otherwise be the case, I think we have to focus on resilience. That means that there are larger buffers in the system, more capital and liquidity in the system, that in any case give banks and people time to respond to the bursting of the bubble, that they do not immediately go bankrupt or get into trouble. Is Dirk back again?
I think so.
Dirk, we lost you, so I took over. Is there anything you would like to add to what you already said?
No. What I said was probably clear. Sorry, I had a battery problem. I wasn't well prepared.
Okay.
I think you were
Then go to
saying
the
that...
next question, Tim.
All right, we're going to continue to the next question then. Some students they asked, and they stated that fragility is a very helpful concept, but how can we actually use it? And that's something you also mentioned in the comment section there. And maybe you can elaborate a little bit on that.
Okay, yeah. So if you go to the discussions, I've responded there to a similar question. I've given references to a couple of papers which apply the concept of fragility. For those listening who haven't followed that, fragility is not crisis. Fragility is precisely so helpful because it's not crisis, but it's the possibility of crisis. So it is much more helpful to know that the system is fragile, namely that it's possible that you're going to have a crisis, and maybe more and more possible over time. That is much more helpful than predicting when a crisis happens, because that's usually not possible, or knowing that you've had a crisis because then it's too late. So fragility is not crisis, but fragility is also not stability. They may go together, as I said earlier. A fragile system, so a system where there could very well be a crisis very soon, a system which could break down, a fragile system may be very stable, but that's not the same. So it's between stability and crisis, you have fragility. Now, how do you know whether a system is fragile? I think this will differ for different complex systems. You should look for patterns, is the general rule. So if you can't do deterministic science, so you can't do science where you're going to predict with 100% certainty what's going to happen, you can still do science, because most of our world is like that, and we do science everywhere, and you do that by looking for patterns. Now, in my own field, in economics, I know about some patterns that indicate that an economy or a financial market is growing fragile, that fragility is increasing. For instance, and this has been well documented and well researched, when leverage is increasing, usually that leads to increasing fragility. You can even look at particular types of leverage. If you look at what banks do, household debt leads to a lot more macroeconomic fragility than business debt. So when banks are shifting their loan portfolios away from non-financial business lending and towards mortgages or consumer lending, that's a telltale sign of increasing fragility. Some people at the Bank of International Settlements, Claudio Borio and others, have done excellent work showing the following. You can even go one step further and say, well, look at asset prices and leverage. So look at the growth in debt relative to income, and look at the increase in asset prices. If that increase is above trend combined with a growth in debt, if you see those two things combined, well, that's an extra strong red signal that fragility is probably increasing. And they wrote this in 2004. So I think that is pretty prescient. So that's useful science that is very concrete. It's with numbers. You can actually apply this concept of fragility, which in itself is a pretty philosophical concept. That's another reason I like it.
Nothing to add on my part, Tim.
Okay. I would like to go to our...
Can I ask one other question somewhere along the line, Tim?
Yeah. Go ahead.
It doesn't have to be right now, but I'd like to ask this. We had a euro crisis 2 years ago, near failure on the part of Spain, Italy, and so on. We can contrast that with the American financial crisis earlier, yet drastically opposite policies were followed. The Angela Merkel policy of austerity and U.S. throwing money at the problem. And I just would like to get your reaction as to the relative merits in this situation or in general of those two ways of dealing with a crisis.
This is a golden question. Dirk?
Yeah, I'm not sure it has too much to do with this week's topic of fragility or complexity in financial systems. It's a very practical policy question. I would first comment on the idea that the Americans threw money at the system. I think the most important thing that the Americans did was to let banks take their loss pretty early on, and so to create transparency about where the losses were. And we didn't do that mostly in Europe for political reasons as well. Banks were keeping local governments hostage and so on. So I think that was a big part of the solution. I'm not sure that the amounts of money were precisely doing the job. Austerity, by and large, I think austerity has failed to bring back growth. It's a big topic really, because if you take Ireland, it had very severe austerity, and it's now doing relatively well, because any economy will bottom out at some point. I think if you look at the merits of both approaches, I think the biggest difference is what I said in the beginning, is that the Americans forced the banking system much more, not by far not completely, but they forced the banking system much more to take their losses. What in both cases hasn't happened is that debt levels have come down much. So private debt levels in households and firms. So I think that's one reason why in both cases we're still seeing very anemic growth. We're seeing decoupling of asset markets like stock markets from the real economy. Asset markets can be going up while the real economy is in a recession or in ultra low growth. All those are signs that things are far from well yet, and that's got to do with the high levels of debt. We're in debt overhang situation. So that's a similarity I'd like to point out, rather than only the differences. Yeah, let me stop here. There's much more to say.
All right. Shall we go to the last question? What are the major lessons to be learned from the financial crisis?
Well, that question is too general, I'm afraid. Lex?
Yeah, let me give my own, let's say, my own perspective, and it's indeed a very general question, and in a way you may even say it's too early to tell. But if I have to come up with an answer now, I would say first lesson is that capital and liquidity had been allowed to fall to too low levels in the economy. So we have to rebuild capital and liquidity. I think the measures taken so far in the context of Basel III go in the right direction, but I must say that I do not still feel comfortable with the level of capital in particular in the system. You see that capital related to total assets, leverage, as we have discussed before, is in many cases in Europe still around 3-4%. I think these are too small buffers. So in my view, the lesson there is that we gradually have to increase those buffers further. Then a second lesson, very relevant, I would say, in the context of our cause, is that in the run-up to the crisis, supervisors, policymakers, governments focus too much on the help of individual banks, individual institutions, thinking that if an individual system were healthy, then the system as a whole would be healthy. And it turned out that the interconnections in the globalized world are very important. So there the lesson is that we have to focus more on policies for the system as a whole, so-called macroprudential policies. Then a third lesson I would say, also trying to think and relate it to the topics of this course, are that we are again the policymakers and the regulators focus too much on risk-based measures of capital, having the prudence to be able to measure the risks, whereas we have in this course stressed that it's not so much risk that is important, it's uncertainty, and that cannot really be measured. So that would point in the direction on focusing going forward less on risk-weighted capital measures and more on so-called leverage measures, just focusing on overall capital related to assets. And a final, not perhaps not final, two other lessons that come to mind. One is that there's been too much focus on, let's say, minimum capital requirements, whereas capital has to play a role as buffer. And if it has to play a role as buffer, it should be able to fall to a certain extent. And to design regimes in which capital can fall and can be used as a buffer I think is an important lesson. And finally, I think it's a lesson is that banks had grown too big and in a way also too complex to fail, and that we have to try to repair that. And I formulate it modestly because it's easier said than done. So this would be the most important lessons as I see them, and also from the perspective of, let's say, discourse. Perhaps more, I think these are the most important ones that I would list in the context of our course.
Yeah, let me add, I've had some time to think. So personally, a lesson that I learned as an economist, which I recognized quite early on in 2009 or thereabouts, or 2008, is that as economists we need to pay attention to the financial sector. I think it's Woody Allen seems to have quipped that money is about economics is about money and why it's good. But the real irony is that that's not the case. A lot of economics is not about money. A lot of macroeconomic models don't have money, don't have debt, don't have a financial sector in them. Now, we live in capitalism. We live in a capitalist system. And capitalism is financial capitalism. It's not capitalism with money added on and you could do without. It's just something that you count in. No. The fact that we have debt, that we have financial flows between actors, that we have balance sheets with assets and liabilities, all that is part of the fundamentals of the economy, and so we should take that into account. And that's an academic lesson. Closing with one, you might say, more broader lesson for society. So in this course we're looking at complex systems. Now what do you define to be the system? I think the system we're interested in is the economy. And the financial sector is a subsystem of the economy, or it's a dimension of the economic system, whichever way you want to look at it. And in the end, the way you look at finance is a normative decision. Do you look at it as a subsystem which is supposed to support the bigger system of the capitalist economy, or do you look at the financial sector in and by itself, whether it's doing well or not? And we've been doing that far too much. There have been studies of the productivity of the financial system or whatever, but it's not difficult to have a very productive financial system producing a lot of loans with very little capital. That's very productive. It's also very dangerous for the economy. So you should look at the system as a whole and not at the financial system as such. Those are two lessons I would highlight.
Thank you, Dirk. I think this is the end of our discussion tonight, isn't it, Tim?
Yes, I think so.
So let me then thank first of all Andrew for participating and for asking a number of very relevant but also tough questions. Thank you very much. Let me also thank Dirk for participating and Tim for moderating everything. I hope you enjoyed it. I did myself. And I believe that tomorrow night, 8 Central European time, we have another hangout, this time discussing the growth and development of cities, also in the context of this course. Very different topic but also very interesting. Once again, thank you all for viewing.
Bye bye.
Bye bye.
Thank you.
Okay, thanks all for joining. Bye-bye.